Good evening, everyone. This is Subash Gangadharan, derivative analyst at HDFC Securities. Myself and Ajit, who's also a derivative analyst at HDFC, will be presenting to you today a webinar on derivatives. We will be looking at the various terms that are used in the derivative markets and more specifically in the futures and options market. We will also look at some basic strategies that can be used by traders. Now, there are basically two segments in the stock market. One is the cash segment, and then we have the derivative segment. The cash segment is concerned with the various stocks that are offered by companies, and people can trade in the market either on an intraday basis or take the delivery. And then we have the derivative segment where we have the futures and options contracts. So we will be looking today in more detail about the futures and options. Now, what are derivatives? Basically, a derivative is a financial instrument whose value is derived from an underlying asset. So this asset could be an equity index, or it could be a commodity or a forex currency. And these contracts are exchange traded or over the counter. Today we will be discussing exchange traded contracts. In the exchange traded contracts, we have the futures and the options contracts. And these contracts offer high leverage and hedging possibilities. The F&O market also offers a lot of data to the market participants. For example, we have the IV data, then open interest, put call ratio. So a lot of data is offered in the markets, and this data can be used to analyze the derivative markets and take appropriate trading positions. Now, Ajit, could you please explain to us what are the various uses of derivatives?
Yes, Shubhas. Before trading into derivatives, we need to understand what are its uses and why derivatives. So as we have discussed, there are two segments where we can trade. That is, one is stock market and one is derivatives market. So why derivative market? So when we are comparing a derivative market with the stock market. The derivative market has a very low cost of transaction. If you see, the STT charges in the cash market is 0.1% of on the total turnover and 325 rupees per crore. Where when we compare to the derivatives market, so like futures, it is 0.01 on the sell side and 190 rupees per crore. So it makes a lot of difference, and we have to understand stock trading or a derivative trading is a is a minus sum game. Everyone thinks it's a zero sum game, but it is a negative sum game because we have to pay in advance something and then we are going to buy. So our loss or break even is after the cost incurred by the exchanges and other stamp duties and etc. So the cost involved in the derivatives is much lower when compared to the stocks. So the second, it is for, we can use it as a arbitrage trading and hedging, and also for the liquidity and leverages. So we will discuss in details what are arbitrage, what is arbitrage, what is, how it can be used for liquidity and leverage. So these are the major uses of derivatives. So next, once we understand what are its uses, let us move on to the market participants, which is which plays a very crucial role. So the main purpose why NSE introduced derivatives, the main purpose of the derivative is to hedge. Suppose you are buying a stock and you see a future event. Because of some event, the stock prices can correct up to a certain level, say 10% or 12%. You want to hedge, but you do not want to sell the stocks. So what NSE has provided the investors is with the derivative future contracts. What you can do is you can sell the far or next strike things. Like for example, the January 2020, you feel that market will go down. in February, so you can sell February contract at a single point of time. There is three contracts which is trading in a exchange, that is January, February and March. As soon as the January expires, new contract is going to add. So any point of time there is three contracts, so we can take the benefit of hedging. The main purpose is of hedging. Second is for arbitrages. Now who are arbitrages? In before introducing introduction of futures, what arbitrages used to do is like they used to do arbitraging in Sensex and in Nifty. So there is to be a spread in these two exchanges, but due to the lack of technological framework, now the technological framework has increased, so there is very less mispricing in NSE and BSE. Now the arbitrage opportunity is there in cash market and in future market. So there are arbitrages. They play important role to generate the liquidity also, unlike the speculators. The third form of the market participants are the speculators, who understand the market direction and they try to speculate by gauging the direction. They are called the speculators. So can you please explain what are futures?
Yeah, sure.
Yeah.
Yeah, futures is basically an agreement between two parties to buy or sell an asset at a certain time in the future at a certain price. Now, in order to create this future position, the trader needs to deposit a margin with his broker. And there's also a mark-to-market margin which is calculated on a daily basis, depending on whether the position is making a profit or a loss. If the position is making a profit, then no additional margins will be asked from the trader. While if the position enters into a loss, then the broker will ask the trader to deposit more margins. Now, there are various terms that are used in the future market. The first one is the spot price. This is the price at which the underlying asset trades in the cash market. And then we have the futures price. This is the price at which the trader has bought the futures contract in the derivative market. Then we also have an expiry date. Each contract has an expiry date. In the Indian F&O market, the expiry date is on the last Thursday of the month. And each contract also has a particular lot size. In the case of the Nifty, one lot is 75 shares. Now we will look at an example of the futures trading. As the PPT shows, Mr. Sharma has bought a futures contract which entitles him to receive 100 shares of ABC Industries at a price of 350 rupees. Now, if the price goes up to 360, then Mr. Sharma makes a profit of rupees 10. Now, Mr. Tripathi has sold three shares at 350, so he has basically shorted the futures contract. Now, if the price falls to 340, then he makes a profit of 10. If the price goes up to 360, then he makes a loss of 10. If the price remains unchanged at 350, then nobody makes any profit or loss. Now, Ajit, could you please explain the various F&O criteria?
Yeah, so let us understand why the stock qualifies for the F&O criteria. So what are the stocks which qualifies for the F&O this thing, criteria? First, to get into an F&O list, the for a firm to be in F&O list, it should be among the top 500 in market cap. So what is market cap? Market cap is a total share outstanding into the share value. So if you multiply the total share outstanding by today's CMP, you will get a market cap. So out of 1000, 2000 stocks which fall into the top 500 criteria, 500 list, it will come into the criteria of F&O. Second is MQSO, that is called median quarter sigma order size in value terms. It should not be less than 25 lakh. We should not go into the integrity of this. What is median quarter sigma? It is derived by the NSE and which is easily available. They always upload an Excel file. We can see what it is. Third is MWPL, that is market wide position limit. So we'll discuss what is market wide position limit. So it should not be less than 500 crores. And the third one is average daily value in cash market should not be less than 10 crores in the previous 6 months. So if any of these criteria, if it fails, they will come into the ban list. We'll understand what is the ban list. But to be in F&O list, it should qualify all the three above given criteria. So let us see what is FNO ban. So when the open interest, we'll discuss what is open interest in the subsequent slide. We'll deep dive into it. First, now for a basic understanding, open interest is a position which is created by buyers and sellers in the market at any given point of time. So it should not cross 95% of the market-wide position limit. If it crosses that, then it will come into the FNO ban criteria. These ban stock can be included further only when OI reduces to 80%. Once it has reached 95%, then it has to reduce by 80% or less than the market wide limit. Then how market wide position limit is calculated? It should be lower than either of 30 times the average number of share that is traded in the cash segment of the previous month, or 20% of the non-promoter holding of a stock. It is very simple. Third, inclusion of a FNO create a positive sentiment, while the ban, when it comes into a ban, it creates a negative sentiment when it is excluded from the FNO list. So why the FNO ban? NEC is very keen to avoid speculative trading getting out of the hand, like over trading. They are not looking for a over trading kind of a thing, since it affects the stability of the market and lead to the loss of confidence. If a trader has violated the FNO ban, so this slide is very important. As a dealer or as a advisor, we should take care of this thing, because it is going to impact our customer. So what we have to take care of? If a trader has violated the FNO ban and increase or decrease a new position in the stock, they have to pay a penalty of 1% of the value of the increased position. Whatever position we increase, we have to pay bare 1% of the total value. That is subject to the 5,000 to the minimum value and maximum up to 1 lakh. So it is an cost for our customers. So we have to take care that we should not fall into this category. We should not advise our customer to trade into a ban list. However, the stock in FNO is not applicable to intraday, because the open interest will not be created for end of the day. Whatever the intraday position will buy and will square it off. So the net open interest will remain unchanged. So when you are trading, you need to be aware of the stock which is into ban. So our from the risk department, we get a mail every morning stating which are the stock which is in the ban category. So please take, you have to take care of this, the stocks which qualifies for the ban, and try not to trade in those stocks. So Subash, let us explain what is open interest.
Yeah, open interest is basically the number of outstanding contracts in the futures and options market. So as this table shows, on day one, if A buys one contract and B sells one contract, then the total OI is now standing at 1. On day two, we see that C buys 4 contracts and D sells 4 contracts. So new participants have entered and they have built fresh positions. So because of that, the open interest increases from 1 to 5. Then on day 3, A sells 1 contract, so he's unwinding his contract, and D is also buying 4 contracts, thereby unwinding his short position. Now in this case, the open interest remains at 5 because there is a counterparty for A and D. So they have built fresh positions in the market, and as a result, the open interest remains at 5. Now we can use the open interest data along with the price data to analyze the markets. If the open interest is increasing and the price also is rising, that is a bullish implication for the underlying stock. Similarly, if the open interest is increasing and the price is falling, then that would mean that people are building short positions, which is a bearish sign for the market. If open interest is decreasing and the price is increasing, then it means that there is short covering, which is considered a mildly bullish signal. Similarly, if the open interest is decreasing and the price is falling, then it means that traders are unwinding their long positions, and it can be considered a mildly bearish outlook for the stock. Now, Ajit, could you please explain about the FNO heat map, which is on the Pro terminal?
Yes. So what our customer can do, we have a flagship product, as we said in the last session also. So what we can do is, like, we can just go and shortlist which are the stocks which are building a fresh long position, fresh short position, and what are the stocks qualifying for the short covering and short build up. So there is one we can see it over here. There is a click. We have to just click view short position, and here we can filter it out, the stocks qualifying for the long or short or any kind of strategy which you want to make. It is a one click and we'll get all the data for that particular day. This data is for that particular day. Yes. So Subhash, what are options?
Yeah, we have now covered the futures market, so we will now talk about options. Basically, options is a contract which gives you the right to buy an underlying asset, but not the obligation. So there are basically two types of options. There is a call option and a put option. Basically, calls are bought if you are bullish on the underlying stock, whereas puts are bought if you are bearish on the stock. So when you're buying an option, you have to pay a premium and your risk is limited to the premium. You can't lose more than the premium that you've paid, and your upside profit is unlimited. Now, you can also be an option seller instead of an option buyer. In this case, you receive a premium, but your risk is unlimited and your profit is limited to the premium that you received. So there are various terms that are used in the options market. One is the option price, which is basically the price that you pay to buy an option. It is also called as a premium. Then each contract also has a strike price. This is the predetermined level at which a specific contract can be bought or sold. Options also have an expiry date and a lot size, which is similar to the futures contract. So as I mentioned earlier, if you're bullish on the underlying stock, you buy a call option or you sell a put option. If you're bearish, you sell a call option or you buy a put option. Now, Ajit, could you please explain more terms that are used in the options market?
Yeah. So there are other important terminologies which one needs to understand before buying and selling of options. So what are those? So first is in the money, out of the money, and at the money. Why it is important to understand this concept? Because whenever we build a strategy, or if we go for a naked long or sell of option, we need to understand which strike price we are going to choose. So if we understand the terminologies very well, so we can go and choose the stock strike price which is really relevant for the market. So in this case, so what is in the money? An option is said to be in the money when its intrinsic value is when the strike price is less than the spot price. And for the ITM put option, strike price is always greater than the spot price. For out of the money, strike price is always greater than the spot price, and for put, strike price is always less than the spot price. And for at the money, it is almost equal. The strike price and the spot price are there almost equal. So with the example, we can see if the Nifty spot is currently trading at 12,200, then for call, this is the example is in case of call. For 12,300 it will become OTM, and for 12,200 it will become ATM, and 12,100 it will become ITM. There are two different concepts called deep out of the money or far out of the money or deep ITM. For example, in this case, if we are choosing a strike price of 12,500 and above, 3 or 4%, 4 to 5% above the strike price in case of index, and 7 to 8% from the spot price up and below in case of stocks. So they are called deep out of the money and deep in the money options. Then there are certain other important terminologies we need to understand. That is intrinsic value. What is intrinsic value? It is the difference between the strike price and the spot price. So the option prices consist of intrinsic value, the premium, whatever we call the premium, it consists of the intrinsic value and the time value. So the time decays. So that is very important to understand what is time value and what is intrinsic value. So it will help us to choose the exact strike price when we gauge the market. So call option intrinsic value is underlying stock price or index current price minus the strike price. And in case of put, the intrinsic value will be the put strike price minus the underlying stock price or the index current price. So we can take a very simple example we can take. So what is intrinsic value? Here the CMP of Nifty is 12,200 and the call is 12,300. So in this case, the intrinsic value is 0. And the important thing we should understand, the intrinsic value cannot be negative. It can be 0 or it can be positive. It cannot be negative. So here, whatever the 30 rupees, the premium amount is only the time value, the time left for the expiry. That is the amount. The 30 rupees is that. And for 12,200, the CMP is 74 rupees. At the same as we discussed earlier also, the intrinsic value will not be negative, it will be 0, and the 74 is the time value. And for call 12,100, for in the money option, the always intrinsic value will be positive. So 142 is a premium value. In that, 12,200 minus 12,100, that is rupees 100, that is an intrinsic value, and the rest of the amount, that is 42, that is a time value. So now from this example you have understood what is intrinsic and time value. This is a formula. It is also important in the exam point of view also. So time to expiry of a contract, as the expiry date nears, the option prime decays. That is called time value. It is also called theta. And time value is option premium minus the intrinsic value. So in the money there will be always intrinsic value and the time value. For OTM there will be only time value. So what are the factors that affects the option price? We'll explain in detail in the next advanced version, but for a basic understanding, let us see how it affects. So we'll take example of call option. Like if we buy call option, what will affect the option price according to different strike prices? So if we buy call option, the higher strike prices will go, the lower will be the option value. In case of call option, the higher strike prices we go, the lower will be the option value. And now the time to expiration. The more time to expiration, the more premium will be the options price. I mean to say, if 12,200 weekly option price, if we compare with the 12,200 monthly expiry, definitely the weekly option expiry will be less valued compared to the monthly expiry. Why? Because there is only 2 to 3 days left for the weekly expiry and a whole month, like around 17 days left for the monthly expiry. So the time value will always be more in the monthly expiry, and because of that reason the price will be more for the monthly expiry. And volatility, which again plays a very important role. The more volatile stock, the highly priced option, and the less volatile stock, the less priced option. So for in case you can compare Tata Steel and SAIL. SAIL is less volatile and Tata Steel is highly volatile. So Tata Steel's implied volatility will always be greater when compared to SAIL. That is why the option price, if you see in the Tata Steel, will be always be higher price than when it is compared to the SAIL. Risk-free interest, it doesn't gives a more impact on the option price, but we need to understand how it impacts. So higher the risk-free interest, the more will be the option premium, and it is very negligible thing, so we can avoid risk-free interest. So Subash, give an example like of a call option buy. What will happen in call option buy and what will happen in call option sell?
Yeah, in the case of call option buy, the risk is limited to the premium and the reward is unlimited depending on how the price moves of the underlying asset. The break-even point, as can be seen in the chart on the PPT slide, is the strike price plus the premium. So the strike price is 500 plus the premium of 4, which means that the break-even point is 504. So profit will be earned only once the underlying asset moves above 504. Now, Ajit, could you please give an example of a put option buy?
Yeah. So first, let us understand why to buy a put option. It is more important. So put option, buying a put option is like a insurance for a stock. If you have a stock and you feel that market will go down, in this expiry or next to expiry. As we said, there are 3 expiry at any given point of time. In that case, investors or hedgers, they think of buying a put option, and whatever premium you are paying, it is similar to the insurance premium what you are paying. It is just you have to protect your stock, you're paying the premium. You never think from making a profit from buying a put option. Only the traders, they will think to make profit from buying a put option. Hedgers will never think to make a profit from a put option. They are just, their main intention is to hedge their portfolio or the stocks which they are holding. But a speculator will definitely think to make a profit from buying a put option. So whenever you feel the market is going to head downwards or southwards, that time you buy a put option, and whatever premium you paid, that is your minimum loss. And buying a put option, you have a maximum profit opportunity. The profit is unlimited. So the what is the break even in case of put option? So whatever the strike price you buy plus the option premium, you have to add the option premium. So if you buy 12,200, if you buy 12 if you buy 12,200 nifty put option, put with a premium of rupees say 50, then you have to deduct that, then 12,150 is your break even. So in here we have given an example of stock ABC. So if you buy ABC 500 put option at rupees 4, and the the current market price for that ABC is 503. So what is our outlook? Our outlook is definitely bearish. That is why we are trying to hedge, or we are trying to buy naked put option. So the break even will be 500 minus 4. And what is 4? That is the premium we have paid. So 496 will be our break even. So profit will come below this level. We have to understand profit will come below this level. Risk is limited to only 4 rupees and profit is unlimited. So if in the same expiry it goes by 10%, 20%, you will get that number of profit in your kitty. So unlimited profit, minimum loss. So now we have understood what is derivatives. So what a trader should think, what to do and what not to do in case of derivatives.
Yeah, it is important to know what to do and what not to do when you trade in the derivative markets. So we will look at the various points. The first point is, do not put all your money in one position. So it's important to have at least 3 positions in the market. Split your money between 3 positions instead of putting in just 1 or 2 positions. That way your money is diversified. It's also important to identify your risk reward ratio. Ideally, you should have a reward of at least 2 times the risk that you're taking on a particular trade. If the reward is more than 2, then it's better, but it should not be less than 2. It is also important to maintain stop losses and hedge your positions to control your risk. And most importantly, you should be thorough of your concept. So suppose you're buying a support, then always make sure that you trade when the stock bounces from a support. So follow a disciplined approach and be thorough of the concept. Now, what not to do? Do not work on anonymous tips or without taking advice of the research team. And do not take high risk with limited reward. As I mentioned earlier, you should look at a trade only if the reward is at least 2 times the risk that you're taking. And do not take more exposure if you're not able to pay the mark-to-market margins. This applies to the futures market. So it's important that you don't take bigger positions if you're not in a position to pay the margins. Now, how to trade with us? You can visit our website hdfcsec.com, or you can trade through the mobile app by downloading the HDFC Securities mobile app. And you can also subscribe to our Pro Terminal, which is a wonderful software which you could use to trade in the markets. So with this, we come to the end of the webinar. We now open the webinar for Q&A. So any questions, please feel free to ask us, and we will try our best to answer them.
Yeah, Subash, we can see there is no questions. I think our webinar is so good that they understood the concept deeply. So
Or maybe they have not understood at all.
it can be either case. We'll see. You can mail it to Shubhas or me. We will try to give whatever best we can. So let us conclude for the day, and we hope to see you for the next advanced version of the derivatives trading.